Okay, hi there, guys. Hi, everybody. I am doing this recorded lecture for a couple few extra chapter 21 exercises. And so I have a couple different exercises picked out. One where we're going to just get additional practice with the journal entries from the leasee side and then the journal entries from the leaseor side. And then I also have one picked out for us that's a sales type lease. And so I'm going to share my screen with you and get those pulled up, and then we will get some practice with this. And so as you can see, I've got a couple picked out here. The first one, exercise 21 3. So this one says, assume that on, and this is one of your homework exercises as well, but it was a good one, to use for practice with these. So assume that on January 1st, 2017, Kimberly Clark Corporation signs a 10-year non-cancelable lease agreement to lease a storage building from Sheffield Storage Company. The following information pertains to this lease agreement. So equal rental payments as required in the lease agreement, beginning on January 1, 2017, 72,000. Fair value of the building on January 1, 2017, 440,000. Estimated economic life of the building in years, 12 years. Unguaranteed residual value of the building, 10,000. Kimberly Clark depreciates similar buildings on the straight line method. The lease is non-renewable. At the termination of the lease, the building reverts to the leaseor. Kimberly Clark's annual incremental borrowing rate is 12%. The leaseor's implicit rate is not known by Kimberly Clark. And then the amount of executory cost included in the yearly rental payment, and these relate to taxes on the property. And so instructions: prepare the journal entry on the leasee's books to reflect the signing of the lease agreement and to record the payments and expenses related to this lease for years 2017, 2018. Kimberly Clark's corporate year end is December 31. So what I want to do is I want to fill out the schedule first. And then once we get the schedule filled out, then we can do our journal entries from there. And so when we're thinking about the leasee first, right? So this is the leasee's amortization schedule, right? That we're looking at, this first one, right? Because lease liability. So this is the leasees. And actually, I'm just going to insert a row up here, and I'm going to just say this is the leasees amortization schedule. And then this is going to be the leaseor's amortization schedule. So we're going to do it, again, from both sides of the transaction. So for the leasee, the date of the lease, 1/1/17. And so remember, when we start off this amortization schedule, we start off with the fair value of the building, if it is known, right? And so when we're looking at this one, we've got what, 440,000. Okay, so 440,000, right? And then remember, we also have the first payment here as well, right? So 1/1/17, we've got annual payment. And here's the annual payment, 72,000, right? So we got annual payment, 72,000. Okay, and then the executory costs, they give us here 2471. So those are our executory costs, 2471. And so what ends up happening is we take that annual payment minus the executory cost when we're figuring in our reduction on the lease liability, right? And so remember, since it's the first year, this is only our first payment. We have not incurred any interest on the lease yet. Our reduction of the lease liability, again, is that annual payment minus the executory cost. So 69,529. And then that lease liability would be down to what? 440,000 minus 69,529. Okay. So now we get to the end of December. Again, we've incurred some interest. Oh, hot dog, that made it real big. We've incurred some interest cost now. And so, you know, same annual payment that we're thinking about, right? I'm trying to think here the best way to do it. Well, I guess maybe the best way is just to say 1118. So 1118, we make another 72, or Kimberly Clark makes another $72,000 payment. 2471 is the executory cost. The interest equals, and we've got to go back up and see what is the interest rate, 12%, right? So equals this number times 0.12. So the interest 44,457. And then again, that reduction of the lease liability equals, hold on, equals the payment minus the executory cost minus the interest. What is that? E34. 25,072. And so our lease liability then is down to 370,471 minus the reduction. All right, now 1119, 72,000, executory cost 2471. But now our interest is down to what? 345,399 times 0.12. And so reduction of lease liability 72 minus 2471 minus, keeps blocking that on me, E35. Yeah, that's E35. Okay. All right. All right. And lease liability equals the previous carrying value minus reduction of lease liability. Okay, let me copy these so we can go through and do the remaining years here. Okay, so 1/1/20, 72,000, 2471. Interest equals the 317 times 0.12. So reduction $31,451. And this is equal to the 317 minus 31,451. Okay, 1/1/21. Oopsie. 1/1/21. 72, 2471 equals 285,866 times 0.12. Reduction again is equal to the payment minus the executory cost minus E37 minus the interest. All right. Now we're down to carrying value of $256.41. And let me see, because this was a 10-year lease. So let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay. And then we're going to copy all these. It's the same lease payment. We're going to copy these because it's the same executory cost. And now the interest equals 256.41 times 0.12. And that automatically puts that in there for us, equals 251 minus 39,452. Okay. So now interest equals 211,189 times 0.12. And it already put the 44 in there for us, so that's nice. Minus 44,186 equals 167,003 times 0.12. And now we're down to carrying value 117,514 equals 117,514 times 0.12. And now we're down to carrying value minus 62,807. So interest 62, or excuse me, 087 times 0.12 and equals minus this. So what, 74.59. Oh, nope, hold on, we went the wrong way with it. We'll say minus 9. So we'd have to reduce the interest that we claimed that last year, but that would get us down to that 0 lease liability. So just right here, we subtracted 9. If we take this away again, it leaves a lease liability of 9, but obviously we're not, we're not going to keep a lease liability of $9 on our books. So I guess maybe the other place we could add it would be here, equals plus 9. That would get us down to 0. So maybe that last payment, we just figure in the difference that's owed. Okay. Anyway, so there's the leasee's amortization schedule filled out. And so now we can think about these journal entries, right? And so on 1/1/17, we would have debited leased equipment, 440,000, and we would have credited lease liability, 440,000, right? That would be our first entry. But then remember, we also have to record our payment on this first, January 1 payment, right? That first $72,000 payment. And so the way that would look, because we've got those executory costs that we have to think about, we would debit lease liability. We're going to debit the executory costs or expenses, right? Expenses increase with the debit. And so here, this is the easiest way to figure it out. So executory costs are $24.71. We know we're making a payment, we're crediting cash 72,000. So the reduction in the lease liability is the difference. And I know this is up here on the amortization schedule as well, but we see it here, the 72 minus 2471. That's our first payment, how our first payment is allocated, right? And so now we get to the end of 2017, December 31, 2017. We have to not only record the interests incurred that year, but we also have to record depreciation, right? So the interest incurred that year is this 44,457. So we're debiting interest expense 44,457. And in fact, here I'll just say equals and I'll go to this number. And then we're crediting interest payable 44,457. And then for depreciation, it told us that they use the straight line method. So we're debiting depreciation expense equals 440,000 divided by 10 years. Right? If we go back up here, you know, it tells us the fair value 440,000 and that this is a 10-year lease, right? 10-year non-cancelable lease agreement. So we're going to depreciate it over 10 years then. And so that's what that one would look like. Oh, and then credit accumulated depreciation. 44000. Okay, and then on 1/1/2018, when we make that next payment, you know, we're essentially going to be doing this one again. So just in an effort to save time, I'm going to copy these. The only difference is we're also going to have a debit to the interest liability. So interest liability. Okay, so the executory costs we know are 2471. The interest liability, or I should say interest payable. I don't know why I did this when we were doing these in class together, but we're going to debit interest payable for the interest 44457. We're going to credit cash for 72,000. And then again, the reduction in the lease liability is the difference in these. So equals 72 minus interest payable minus executory cost, 25,072. And again, those are our numbers right here, right? How our payment is allocated. Okay. So then we get to the end of 2018, 12/31/18. We have to record interest for the year. And then we also have to record our depreciation. So we're going to do these same two entries. So again, just to save time, I'm going to copy and paste. The interest expense, however, now this is the second year of interest. So here are the numbers for our second year of interest. So our interest liability in 2018, 41448. 41448. 41448. And I guess, in fact, I could just say equals and grab the number up there. So when we're looking at it, we can remember where our number came from. And then interest payable, same amount, 448. And then depreciation expense, again, same amount, straight line depreciation. So the same every year is what that would look like. And lastly, you know, I won't go through all of them. Hopefully you're getting the idea, but let's look at then the 2019 payment and how that's allocated. And again, we're going to have these same accounts impacted. And so we're going to say executory cost are 2471, interest payable 41,448, cash 72. And again, the reduction in the lease liability is the difference of all these things. Minus. So 28,081. And again, we see those numbers up here. that we just plugged in. So anyway, those are the numbers and how we would fill that out from the leasee's perspective. And just to give you an example of those entries. And then let's look at it. I know it's not asking us to do this in the problem or in the exercise. It's not asking us to take it from the leaseor's perspective as well. But let's just do it to to get practice with it. And so we'll copy these dates here. Let's see. Copy, paste. All right, we can fill this all in. All right. Annual payment. So, same thing, like even though now we're from the, and I don't think, oh, this is supposed to say lease receivable. I thought I changed all of them, but apparently I didn't change this one. This one is supposed to say lease receivable. Okay, and so we still started with the 440,000, just like we did on the other side. And then, we basically record all the same things. So the annual payment, 72,000. The executory cost, 2,000. The interest on lease receivable, that first payment is 0. So the lease reduction, oh, hot dog, I said 2,000. It's 2,471. Yes. So then the lease reduction, again, the difference between these two, 72 minus 2,471 equals 440 minus 69,529. All right, second annual payment, 72, 2,471. Now we've got interest though, times 0.12. And then reduction equals the payment minus executory cost minus interest. All right. Equals 370 minus the reduction. Okay. So now I am going to just pull this. It looks the same way. Again, it's just from the leasor's perspective instead of the leasee's perspective. But we pull these all down and populate this, again, we see that it ends in that $9. We can adjust this on the schedule somewhere similar to that, right? Okay, but now let's look at the entries from the leasor's perspective. So again, 1/1/17, we're debiting lease receivable, 440,000. We are crediting leased equipment, is what that first one would look like, or simply crediting equipment, either way. And then we have to record the payment. And so for the payment, we're debiting cash, 72,000. Crediting lease receivable. For the amount of our reduction, which again, our first payment, 69,529. And then we're crediting, because I believe those executory costs had to deal with the property taxes. Executory costs relate to taxes on the property. And so we have to credit property tax payable. 2,471. Yeah, and in fact, in the book, I'm looking at an example on page 1214, and it says property tax expense / payable. Okay, and then so now on December 31, 17, we have to record the interest revenue that has been earned to that point. And so for this one, we are debiting interest receivable 44457, crediting interest revenue. Spell that right. Interest revenue 44457 is what that one would look like. And then on January 1, 2018, when we get our next payment from them, we would debit cash 72,000. We would credit lease receivable. And let's hold off on that amount. We would credit property tax expense / payable. And then we'd also have to credit interest receivable. Oopsie. Receivable. Okay, so our interest receivable is going to be 44457. We know that the property tax expense is 2471. And so the reduction of the lease receivable is again the difference in these. So 72 minus the expense minus interest receivable, 25072. And again, those are our numbers for that. Let's do one more year. So let's do now, okay, now we're at the end of the December 31, 2018. We have to do this one again. So just in an effort to save time, I'm copying and pasting. However, the amount is now, because we're at the end of 2018, so that's the second year of interest, 41,448. 41,448. And then January 1, 2019, again, our payment is going to look just like this, or how we allocate our payment is just going to be just like this. So we've got the debit 72,000. We know that the property taxes are 2471. We know we're going to have interest receivable 41,448. The difference in the reduction of the lease receivable 72 minus 2471 minus 41,448. All right. So anyway, hopefully that helped kind of explain this a little bit more. I know we got a good amount of practice in class with it together, but just so we know what these entries look like and we're feeling good with that. I have one more picked out, and this is actually an example of the sales type lease. So I said in class that we would practice one that was the sales type lease. And so just like it shows in our book, and again, I know we kind of talked about this in class a little bit, but just like it shows in our book, the sales type lease, and I'm trying to get you a page number real quick here. The sales, so when we think about the direct financing lease, which we just got practice essentially with a direct financing lease, we record that interest revenue, right? Because the fair value of the asset equals the cost of the asset. There's no difference between the fair value of the asset, the cost of the asset. So we record, the difference in interest revenue, right, as the leaseor. But with a sales type lease, as we mentioned in class, there is a difference between the fair value and the cost of the asset. So we have to recognize some cost of goods sold, essentially, right? We're going to have cost of goods sold and gross profit, essentially, because we're leasing the asset for more than it cost, basically, right? The fair value does not equal the cost of the asset. And so that's what we're going to be looking at with this one. And so this one says, Crosley Company, a machinery dealer, leased a machine to Dexter Corporation on January 1, 2017. The first payment is received on January 1, 2017. Collectability of the lease is reasonably predictable and no important uncertainties surround the amount of cost yet to be incurred by Crosley. The machine has no residual value and reverts back to Crosley at the termination of the lease. Information concerning the lease appears below. So the lease term in years rather is 8. Annual payments at the beginning of each year, $35,013. Cost of purchasing the machine during 2016 by Crosley. So Crosley paid $160,000 for this machinery that it's going to lease to Dexter, right? And so remember the fair value, and we're getting ready to calculate that, right? The fair value or the present value of the lease, right, is going to be greater than this cost. And so that's where, that sales type, right? That's how we determine if it's a sales type lease, because we're going to have some cost of goods sold, some gross profit that has to be figured in. So rate used by Crosley to set the annual rental payment, 11%. And then the economic life of the machine in years, 10 years. So compute the amount of lease receivable, and we're not going to do Excel's present value function. We're just going to use our tables like we're used to doing, right? So compute the amount of lease receivable. Okay. So we've got annual payments, 35,013, and we're going to say times, and we need the present value factor. Remember, present value of annuity due factor. And so this is 11% for 8 years. Okay, so 11% for 8 years. Getting my tables pulled up here. Present value of ordinary. Okay, present value of annuity due. 11% for 8 years. 11% for 8 years. Okay, and so this present value factor, if we look at 11% for 8 years, it is 5.71220 equals, and let me get my computer calculator since I'm not, and turn this in here. So 35013 times 5.71220. So $200,001 is what that comes out to be. 200,001. So that is the amount of the lease receivable, right? The present value of the payments, or the fair value right now, 200,001. So again, we've got a difference in this present value or fair value, 200,001, versus this cost of Crosley purchasing the machine, right? And so, direct type lease, fair value equals the cost of the asset. A sales type lease, fair value does not equal the cost of the asset. And so we've got the gross profit. We're going to have some gross profit on this. We're going to have, recognized cost of goods sold, right? So that's what we're looking at on this one. And so the entries to record this, again, like we said, we're going to have cost of goods sold that we need to recognize. Also, we have to reduce inventory by that amount. So for this one, on January 1, 17, and maybe it'd be best to go one more back. So on January 1, 17, we are, go out a little so it shows the date. Okay, so we are going to, because we're the leaseor, right? So we're going to debit lease receivable. 200001, right? We're going, remember, cost of goods sold increases with the debit. So we're going to debit cost of goods sold, 160,000. We're going to credit sales revenue. 200001. And then we're going to credit inventory. 160,000 is what that first entry would look like, right? And then remember, we have to also record their first payment. So then that's a debit to cash, 35013, and then a credit to lease receivable, 35013. Is what that one would look like. All right. And so then we can, at the end of 2017, record the interest. Make this a little bit bigger so it shows us, right? So the end of 2017, we can record the interest. And so the carrying value at this point is what? It was 200001. And now we're going to say minus 35013. Oh, hot dog. 35013. And so equals 2001 minus 35013. So we're going to base our interest on that carrying value at this point, 164,988. And so for interest, we're going to say what? Debit interest receivable. Interest receivable. Oh, if I could type debit interest receivable is going to be equal to this number times 0.11, because that's the interest rate that they gave us. If we scroll back up, right, rate is 11%, so 0.11. Credit interest revenue. Revenue 148.68 is what that one would look like. Right, so we recognize the interest revenue. And I forget what it said on this one. The machine has no residual value. That's right. So no residual value on this one, right? And so we looked at our interest. And so we can look at then what the payment would be on 1/1/2018. Right, so cash 35013. But now we're going to have a credit to interest receivable. And then we're also going to have a credit to lease receivable. Okay, so the interest receivable, we calculated 18148.68, which they probably would round up, but it's fine. That's our number we came up with. And then lease receivable, reduction of the lease, the difference between these two numbers is what that one would look like. Anyway, in the actual problem, they were only asking us to go through the end of 2017, but just to give us an idea again and get more practice with this. So, sales type lease, direct lease, again, like we talked about in class and like we just talked about when we started this exercise. The major difference between these two is that the fair value or the present value of minimum lease payments is greater than the cost of the asset, the cost of the machine in this case, right? So we've got that cost of goods sold that has to be recognized and the sales revenue. And we know that the difference between the cost of goods sold, the sales revenue is the gross profit, right? So we've got gross profit on these transactions as well. So anyway, hopefully that was helpful to you guys. I don't want to go, I forgot to time myself, so I'm not sure how long we've been at this, but I kind of wanted to make it about as long as a class would be. So hopefully I did that. I'm going to stop sharing this screen now. Hi guys, hello. Okay, and yeah, and so that concludes chapter 21, and then we will start chapter 22 on Monday. And so I look forward to going over that with you guys on Monday. Bye-bye. See you later.